Welcome to our comprehensive guide on personal finance, brought to you by the Securities and Exchange Board of India. In today's world, financial literacy is more important than ever. It's not just about managing money, but about making informed decisions that shape your future. Many people face challenges like complex financial products, fraudulent schemes, and the need to plan for retirement. This video will help you understand the basics of personal finance, from managing income and expenses to making smart investments. By the end, you'll be equipped to take control of your financial well-being and make choices that lead to a secure future. Financial planning is essential for every household. It goes beyond just saving money. It's about creating a purposeful plan for your future income and expenses. Proper financial planning helps you budget, invest wisely, and prepare for life's milestones, such as buying a home, funding your child's education, or ensuring a comfortable retirement. By understanding and managing your income, expenditure, assets, and liabilities, you can achieve better financial well-being. This guide will walk you through the key concepts and strategies to help you make informed decisions and reach your financial goals. Let's start with savings. Savings are the surplus of your income over your expenditure. In simple terms, it's the money left after you've paid for all your essentials and non-essentials. People usually use their savings to meet short-term goals or emergencies. Savings accounts in banks or post offices offer a safe place to store your money, earning a small amount of interest and allowing easy withdrawal. Building a habit of saving is the first step towards financial security and achieving your goals, whether it's a vacation, a new gadget, or an emergency fund. Investing is about putting your savings to work. When you invest, you deploy money into financial or non-financial products with the expectation of earning higher returns over time. Investments can be in fixed deposits, shares, mutual funds, land, gold, or other assets. Unlike savings, investments are aimed at growing your wealth and achieving long-term goals. However, it's important to remember that investments come with risks. The value may rise or fall. Understanding the difference between savings and investments helps you balance safety and growth in your financial journey. Let's compare savings and investments. Savings are meant for liquidity and short-term needs, offering low risk and easy access to funds. Investments, on the other hand, are designed to grow your money by creating assets that can generate income or appreciate in value. Investments may be less liquid and carry higher risks, but they offer the potential for greater returns. By understanding the purpose, risk, and liquidity of each, you can make better decisions about where to put your money based on your goals and risk tolerance. Starting to save and invest early in life gives you a significant advantage. The earlier you begin, the more time your money has to grow, helping you reach goals like buying a house, funding education, or building a retirement fund. Early investments benefit from compounding, where your returns generate even more returns over time. By making saving and investing a habit from a young age, you set yourself up for financial stability and the ability to handle life's uncertainties with confidence. Understanding assets and liabilities is crucial for managing your finances. Assets are items you own that have economic value, such as savings, investments, property, or vehicles. Liabilities are what you owe to others, like loans or credit card debt. For example, a fixed deposit is your asset, while a car loan is your liability. Knowing the difference helps you calculate your net worth and make informed decisions about borrowing, investing, and spending. Debt is money borrowed to cover expenses when your funds fall short. It can help you meet urgent needs or invest in opportunities, but it also comes with the responsibility of repayment. Managing debt wisely means borrowing only what you can afford to repay and using loans for productive purposes. Uncontrolled debt can lead to financial stress, so always assess your ability to repay before taking on new obligations. Time value of money is a fundamental concept in finance. It means that money you have today is worth more than the same amount in the future, due to its potential to earn interest or returns. For example, rupee 500 today can be invested to grow over time, but 5 years from now, inflation may reduce its purchasing power. Understanding this concept helps you make better decisions about saving, investing, and spending. Inflation refers to the rise in prices of goods and services over time. As prices increase, the purchasing power of your money decreases. For example, something that cost 5 years ago may now cost rupee 7, not because of better quality but due to inflation. When planning your finances, it's important to consider inflation, as it can erode the value of your savings and investments if your returns don't keep up with rising costs. Protect your money from inflation. Focus on your real rate of return, the return you earn after accounting for inflation. If your investments grow at a rate equal to or higher than inflation, you maintain or increase your purchasing power. Always compare the expected returns of your investments with the prevailing inflation rate to ensure your money is truly growing. Compounding is the process where you earn interest not just on your initial investment, but also on the interest that accumulates over time. This creates a snowball effect, allowing your money to grow faster. For example, an initial investment of 1,000 can grow to over rupee 31,000 in 40 years at a 9% annual return thanks to compounding. The key is to start early and let your investments grow over time. The rule of 72 is a simple way to estimate how long it will take to double your money at a given interest rate. Just divide 72 by the annual interest rate. For example, at 6% interest, your money will double in about 12 years. This rule helps you quickly assess the power of compounding and make better investment decisions. P-cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. This strategy helps you buy more units when prices are low and fewer when prices are high, averaging out your cost over time. It reduces the impact of market volatility and removes the stress of trying to time the market, making investing simpler and more disciplined. Financial planning is the process of estimating your financial needs and creating a plan to meet them throughout your life. It It covers everything from planning for a child's education to buying a house, preparing for emergencies, and ensuring a comfortable retirement. By understanding your current financial situation and setting clear goals, you can make informed decisions that lead to long-term security. Before you can plan for the future, you need to know where you stand today. Assess your income, expenses, assets, and liabilities to calculate your net worth. This gives you a clear picture of your financial health and helps you set realistic goals. Regularly reviewing your financial situation ensures you stay on track and make adjustments as needed. Financial goals give you direction and purpose. They can be basic like food and shelter, secondary like education or buying a house, or long-term like retirement planning. Good financial goals are smart, specific, measurable, achievable, realistic, and time-bound. By setting clear goals, you can create a roadmap for your financial journey and measure your progress along the way. Achieving your financial goals involves a 5-step approach. 1. Identify specific goals. 2. Classify them as short, medium, or long-term. 3. Decide on asset allocation. 4. Diversify your investments. And 5. Review and revise your plans regularly. This structured process helps you stay focused, manage risks, and adapt to changes in your life or the market. Asset allocation means spreading your investments across different asset classes such as equity, debt, and gold, based on your goals, risk tolerance, and time horizon. Diversification further reduces risk by investing in a variety of instruments within each asset class. Remember, don't put all your eggs in one basket. Diversification is key to balancing risk and reward. Financial planning is not a one-time activity. Regularly review your goals and investments to ensure you're on track. Life circumstances and market conditions change, so your plan should be flexible. Adjust your asset allocation, update your goals, and stay informed about new opportunities or risks. This proactive approach keeps your finances healthy and aligned with your objectives. There are various investment products available, each with its own risk and return profile. Fixed income securities, equities, and mutual funds are common options. Equities offer higher returns but come with higher risk, while debt instruments are safer but yield lower returns. Government bonds are considered risk-free. Always consider your risk tolerance and investment horizon when choosing where to invest. Every investment decision is influenced by 3 pillars: safety, liquidity, and return. Safety refers to the protection of your principal and returns. Liquidity is how easily you can convert your investment to cash. Return is the income or appreciation you earn. Balancing these 3 factors helps you choose investments that fit your needs and risk appetite. Returns from investments can come in 2 forms: regular income and capital appreciation. Regular income includes dividends from equities or interest from debt instruments. Capital appreciation is the increase in the value of your investment over time. For example, if you buy shares at Rupee 50 and sell at Rupee 65, the difference is your capital gain. Both forms of return contribute to your overall wealth. Risk is the possibility of losing money or not achieving expected returns. All investments carry some level of risk, but higher risks often come with the potential for higher rewards. Understanding the risks involved helps you make informed choices and avoid surprises. Always do your due diligence and be cautious of investments promising unusually high returns. Keeping your money in banks is safer than holding cash at home. Banks are regulated by the Reserve Bank of India and offer deposit insurance up to 5 lakhs per customer. Bank deposits are low risk, provide liquidity, and make you eligible for loans. Banks also offer various types of accounts to suit different needs, from savings to fixed deposits. Open a bank account, you must comply with Know Your Customer (KYC) norms. This process helps banks verify your identity and address, reducing the risk of fraud. Common KYC documents include a photograph, proof of identity like PAN or Aadhaar, and proof of address like a utility bill or passport. Completing KYC is essential for accessing banking services. Banks offer various types of accounts, each with unique features. Savings accounts are highly liquid and suitable for everyday needs. Fixed deposits offer higher interest for locking in funds. Recurring deposits let you save a fixed amount monthly. Special term deposits provide tax benefits. Choose the account type that matches your financial goals and liquidity needs. Digital banking has made managing money easier than ever. You can transfer funds, pay bills, and shop online using platforms like NEFT, RTGS, IMPS, and UPI. These services offer convenience, speed, and security. Always use secure networks and keep your passwords safe to protect your accounts from unauthorized access. Reserve Bank of India has introduced new types of banks, such as payment banks and small finance banks, to promote financial inclusion. Payment banks offer basic savings and remittance services but cannot issue loans. Small finance banks cater to underserved populations with small deposits and loans. Business correspondents help bring banking services to remote areas. Digital payments are convenient, but it's important to follow best practices for security. Use strong passwords, update your apps, and avoid public Wi-Fi for banking. Never share your PIN or passwords and report unauthorized transactions immediately. Staying vigilant helps protect your money in the digital world. Credit and debit cards offer different benefits. Credit cards let you borrow money up to a limit and pay later, while debit cards draw directly from your bank account. Both can be used for ATM withdrawals and digital transactions. Use credit cards responsibly to avoid debt and always keep your PIN secure. Reserve Bank of India has set clear rules on customer liability for unauthorized transactions. If fraud occurs due to the bank's fault, you are not liable. If neither party is at fault, report the issue within 3 days to avoid liability. Always monitor your account and report suspicious activity promptly to stay protected. Reserve Bank of India (RBI) is the country's central bank responsible for regulating the currency and credit systems. It supervises commercial banks, formulates monetary policy, and ensures financial stability. RBI acts as the banker to the government and is the lender of last resort for banks, playing a crucial role in India's financial system. Before investing in the securities market, it's important to understand the risks involved. There are several types of risks, including market, inflation, liquidity, business volatility, and currency risks. Diversifying your investments and understanding your risk tolerance can help you manage these risks and make informed decisions. Securities market has two main segments: the primary market, where companies issue new stocks and bonds, and the secondary market, where existing securities are traded. To invest, you need a savings account, a trading account with a SBI registered broker, and a demat account to hold your securities in electronic form. To invest in the securities market, you must complete the Know Your Client (KYC) process with your broker or depository participant. This involves submitting proof of identity and address, such as PAN or Aadhaar. KYC is mandatory and helps prevent money laundering and fraud in the market. Trading on stock exchanges happens on all working days. After buying shares, you must pay your broker before the pay-in day, and your shares are credited after the payout day. The settlement cycle is typically T+2, meaning trades are settled 2 working days after the transaction. Understanding this process helps you manage your investments efficiently. Mutual funds pool money from many investors and invest in stocks, bonds, or other assets. They offer professional management, diversification, and liquidity. Mutual funds are suitable for all types of investors, from conservative to aggressive, and come in various categories based on risk and investment objectives. Systematic Investment Plan (SIP) lets you invest a fixed amount regularly in a mutual fund scheme. SIPs help you build wealth over time, benefit from rupee cost averaging, and cultivate disciplined saving habits. Even small amounts invested consistently can grow significantly due to the power of compounding. Commodities like gold, oil, and agricultural products are traded in the commodity derivatives market. This market helps producers and consumers manage price risks through contracts like forwards, futures, and options. Participating in commodity markets can diversify your portfolio, but it's important to understand the risks involved. Insurance protects you from significant financial losses due to unforeseen events. By paying a periodic premium, you transfer the risk to the insurer. There are various types of insurance, including life, health, motor, travel, and property insurance. Choosing the right insurance helps you manage risks and secure your financial future. Planning for retirement ensures you have financial security when you stop working. Pension plans provide regular income in old age, while retirement planning helps you allocate savings for medical and living expenses. Starting early and reviewing your plan regularly are key to a comfortable retirement. Estate planning involves deciding how your assets will be distributed after your death. Making a will ensures your wishes are followed and helps avoid disputes among heirs. Nomination and power of attorney are also important tools for smooth transfer of assets and managing affairs if you're unable to do so yourself. Borrowing helps you meet financial goals when savings are insufficient. Loans come in various forms, such as personal, vehicle, education, and housing loans. Lenders assess your capacity, character, capital, collateral, and conditions before approving loans. Maintaining a good credit score increases your chances of loan approval and better terms. Government offers various schemes to encourage savings and investment, such as Sukanya Samriddhi Yojana, PPF, NSC, and Kisan Vikas Patra. These schemes offer tax benefits, safety, and attractive interest rates. Understanding the features of each scheme helps you choose the best options for your financial goals.